So here we go. The accounting equation. It's important. It's going to be with you the rest of the time we're in this course. It might not be apparent in a few weeks, but it's still there. It's always there. Okay, it's huge. So what we'll have is assets equal liabilities plus equity. Assets equal liabilities plus equity. Assets are resources a company owns or controls that are expected to carry future benefits. Examples: cash, supplies, equipment, land, buildings, cars. Accounts receivable, we'll learn more about that soon, but we're promised that we'll be paid. And so that's an asset. We're going to get money in the future. Somebody's promised with a legal binding contract that we'll be paid in the future. That is an asset. Liabilities. It's money we owe. It's also creditors, the people we owe. Creditors are the people we owe. They basically have a claim on the assets of the company. That's why half of the equation equals, right? Assets equal the total of liabilities and equity. Creditors have a claim on assets. They are wages payable. We need to pay our employees. Accounts payable, we owe money. Notes payable, we owe money. Taxes, we owe money to the IRS, the state of South Carolina. Equity, those are the owner's claims on the assets. So the owners, equity, have a claim on the assets. So how do we pay for our assets? Borrow money, owners invest money, assets. Equity. And examples are common stock, right? We all know, we've seen movies where people are, on Wall Street and they're buying stock in, movies, right? So what makes up equity? Well, it's a combination of these right here. Common stock, owner investment. So an owner buys stock and now the company has money to buy assets. A company makes money, revenues. That increases equity. Expenses decrease revenues. Okay? So technically we have what's the expanded equation. So assets equal liabilities. And then we break down equity into common stock minus cash dividends. And cash dividends are awesome. You own stock in a company, and just because you own stock in a company, they give you some money. They pay a dividend, cash dividend. There's different kinds of dividends. So I'm talking about cash dividends. They send you a check. It's so cool. I own money in my old mortgage company that I used to work for before I went in teaching college. And every January, February, they send me a dividend check. That's pretty cool. I don't work there anymore. I just own stock in the company and they send me a check. That's not bad. I kind of like it. It puts a smile on my face, especially when the return, the dividend as a percent based on what I have in the stock is higher than I'm getting at the bank. Before they started raising rates. This is fall of 2022 when I'm making this video, and rates have just been increased dramatically in the last 6 months. Anyway, dividends. So common stock is a plus, dividends is a minus because they're paying out and it lowers equity. Revenues increases equity, and expenses lowers equity. Okay. Just a real quick little comment on an important ratio, return on assets. It's also called, we also have another one called return on investment. And when we evaluate or look at ratios such as this, they're useful for evaluating management, forecasting profits. Return on assets is calculated, just focused on return on assets, is dividing net income for, like, say, a year, divided by average total assets for a year. So January 1 assets, total assets, plus December 31st total assets, divided by 2, and that's your average. So how well did they use those assets to make money? One ratio doesn't always tell a story by itself. I would want to know about debt and equity, the other part of the equation. But as far as how well they made money with assets, it does tell the picture about how management is managing those assets, how they're being used to make profit, and we can compare that to other companies to see how the other companies do. We could look at the industry average and see how the industry as a whole manages. And you're probably thinking, why do we need a ratio? Why can't we just look at the profit of one company and the profit of another company? Well, let's just stay with cars. Ford is bigger than Chrysler. If you looked at Chrysler by itself, not with Chrysler and whatever, what's the name of that Italian company owns it? Fiat. Or Toyota's bigger. GM, I think, might be bigger. They're bigger than Tesla. So dollars don't give the true picture because companies are different sizes. What gives a true picture is when we convert it to a percent. Then we compare one company to another based on those percentages. Okay? All right, so this concludes part 2 of chapter 1. Again, very important terminology. Please work through this. Start learning what we mean by these terms. And I'll see you in chapter 2. Chapter 2 and 3 is heavily tested on exam 1. But we got to know these terms so we can be productive and efficient in chapters 2 and 3. Thank you.